fundsupermart.com.
Hi Tom, what's the outlook for the US high yield sector, and how is the impact of impending rising interest rates?
Sure. The high yield market this year, 2014, we think returns will be 6 to 8%. We think next year we'll see similar returns. The credit quality of the market continues to improve. Fundamentals continue to be good where we're in a low default rate environment. We have seen volatility in markets around the world recently, which does have an impact on technicals in the high yield market, but fundamentals continue to be strong where we think the U.S. economy is good. And again, we think credit quality will continue to improve. When you look at the outlook for interest rates, we do think ultimately rates will begin to rise. With the slowdown in global growth, that rise in rates has been pushed out into the future. But typically, the U.S. high yield market, when interest rates rise, spreads continue to compress, so returns are still good because interest rates are rising in an environment where credit quality is improving, which is good for credit.
So is the recent volatility in the high yield space a cause for concern?
The cause for concern in the high yield market would be if credit conditions were continuing to become worse, if defaults were going to start rising in the near future. The volatility that we've seen in markets has really been driven by global volatility that really has not, or will not, or should not impact the fundamentals of high yield. So while you'll see volatility in prices in the short term, we think as prices come down in the short term, we think that becomes a buying opportunity. As we look out into the long term, again, we think fundamentals continue to be good, and we think ultimately you'll see good returns in the market.
We've witnessed some yield compression for the US high yield sector. So is this still a good time to invest in US high yield?
Sure. Yields have come down, but that really is primarily because rates have come down so much over the past 4 or 5 years. If you look at spreads that are around plus 500. And to us, the tights in high yield back in 2007, were at around plus 270. So we think spreads can continue to compress, which means returns can still be good. So even though yields have come down, it really has been driven by just lower treasury rates, and that you see those lower rates around the world.
How does the Neuberger Berman high yield bond strategy differ from its peers?
Sure. We've been managing high yield now for about 20 years. And if you look over our long-term track record, we've done a good job of avoiding defaults. We've only had one default in our portfolio in the past 20 years. The high yield markets had about 1,000 defaults in that same time period. So I think we've done a good job of really avoiding the downside and giving investors really a coupon type like return over the long term.